Chapter 4, Income Statement, Comprehensive Income, and the Statement of Cash Flows. In this chapter, I will introduce two financial statements. Income statement reports a company's financial performance during a period of time. The comprehensive income report the both realized earnings and unrealized earnings. The statement of cash flows reports the movement of cash flows. Income statement, also called statement of operations or statement of earnings. It reports a company's financial performance during a period of time. For income statement reported in 10Q, so this is income statement for the past 3 months. The income statement reported in a 10K, we know that's the financial performance for the past 12 months. Comprehensive income reports both realized and unrealized. The realized earnings is actually earnings, which is the bottom line of income statements. Well, unrealized is the other, which includes unrealized holding gains and losses that were excluded from income statement. And statement of cash flow provide information regarding either cash inflows or cash outflows. Statement of cash flow provides information regarding the net cash flow from operating activities, net cash flow from investment activities, and cash flow from financing activities. So by learning the cash receipts and cash payments from these three activities, we can learn about the company's financial risk, profitability, and strategies. This is an example of income statements. Usually the company report 2 or 3 years earnings. So the current year was 2024, 23 was prior year. The 2 years numbers provide us an opportunity to compare the change in each item. And the income statements starts from the sales revenue. As I said, this is the top line. The bottom line is earnings or net income. Under the net income, this section reports the per share value or earnings per share, either basic earnings per share or diluted earnings per share. Different companies may report different components of income statements due to different circumstances. I will introduce in details later. In this example, the company reports either the income from continuing operation or discontinued operation. A discontinued operation represents the after-tax gains and losses from discontinuing this operation. For example, a company may terminate one of its products or operating segment, so the company will report this discontinued operation in this section, which is an unusual item. The discontinued operation is not as frequent as this section above. Okay, and the income from continued operation can be disaggregated into operating section and non-operating section. Above operating income, these activities are related to the company's ongoing major business activities, while under are more peripheral or incidental, or these activities are more relevant to the company's investing and financing activities. While income tax expense cannot be avoided to the different governments, the local government, federal government, state government, or even foreign governments. Income statement reports, in some textbook, we only include 2 elements, but some others can further classify it into 4. The difference between revenues, expenses, and gain losses. Revenue expenses represents the activities that are related to the company's ongoing business, while gain losses are not, are less relevant to the company's ongoing business. However, revenue gains both increase the company's equity, while expense losses both decrease the company's equity. The definition of revenue is the inflow of resources result from providing goods and service to customers. So this is result from the transaction with the customers. So the inflow of resources may represent cash receipts or accounts receivable. Right? The company recognized revenue. The reason the company recognized revenue because it is a result from providing goods and service. It doesn't matter whether the company received cash or not. Similarly, expenses represents the outflow of resources incurred while generating revenue. So this provides us a relation between expense and revenue. Expense and revenue should be matched. So their difference, income, will be useful for the investors and the creditors. So the expenses actually are outflows of resources that are used to generate revenues. The purpose of incurring these expenses is to generate revenue. So outflow of the resources, for example, the company may recognize expense by debit expense. Well, it may credit cash, this is resources, outflow, or we may credit any assets like for example, supplies, right? So these are outflow of resources. Revenue represents the outcome from providing goods and service. Expenses represent the cost by providing the goods and service. The difference is the margin. The income statement is useful because revenue expenses, when we report them, they are matched. This matching is either from a causal relationship or not. So the income statement report different expenses in the different sections regarding the existence of this causal relationship. So if the expense has relation with the revenue generation, the answer is yes. We will report it in the same period with the related revenue. For example, a company recognized sales revenue, so we are going to debit, for example, cash and revenue. At the same time, we should also recognize cost of goods sold, which is an expense, and the credit inventory. These two actually occurs at the same time because the cost of inventory, this is an asset. It becomes expense because there is a sales. If there's no inventory, the company has nothing to sell, there's no revenues. So these two are matched perfectly. So that's why the cost of goods sold is the first expense to be reported in the income statement. Take a look at this one. Because this expense has direct causal relation with the revenue generation. While some other costs may not have this causal relationship, we report somewhere else. And these expenses in the cost accounting, we give a name as period cost. So these costs are incurred during this accounting period or this accounting cycle. We just report it in this period in the income statement. The example includes the selling expense, general administrative expenses, research and development, so on and so forth. This expense has no direct relation with the revenue generation. For example, how much the company spend on research and development does not have direct relationship with a specific revenue, right? Yeah, but it does incur during one accounting period. We just record it during that accounting period. The better matching between these two, the more useful of the income statements. Gain and losses, as I mentioned, they are similar to revenue and expenses. The difference is gains and losses represents the inflow or outflow of resources from peripheral and incidental transactions. The example is the gains and losses arise from when a company sells its assets or settled its liabilities. So the company either recognize gains and losses from these activities. But the sales of these assets or retire or settle the settlement of the liabilities is not the company's core or major business. And gain and losses depends on the price when it sells and the book value of assets. So if the price is greater than the book value, the company is going to recognize a gain. In contrast, the loss should be recognized. We know Walmart ongoing business is to sell its goods as a retailer. So the sales of goods are recognized as sales revenue, and the cost of goods is recognized as expense. But if Walmart sold one of its semi-truck, used semi-truck, the gain and losses will not be reported as expenses or revenue. It should be recorded as gain and losses, since Walmart's major business is not sales of semi-truck. Again, let's revisit the example of income statements. So here, this is the section of income from continuing operation. It breaks down it into operating section and non-operating section. So the interest income and interest expenses, gains on sales of investments, these are more related to the company's investing and financing activities. Interest income is earned from investing activities in the financial assets. Gain and losses from sales of investments, that's from investing activities. Interest expense is incurred from the financing activities through borrowing activities. Okay, following the continuing operation, the last expenses we always recognize is income tax expenses. Since this section we have already deducted income tax expenses, so the numbers I circled, they are both after-tax numbers. All these above are before tax numbers. So if anything reported under this line, they should be reported net of tax. We revisit this income statement. Look, following the income from continuing operation, we see these numbers, these continued operation, right? So these are reported as net of tax amount. These numbers are all after tax. Otherwise, you cannot add a pre-tax income to after-tax income. One more example, the income statement of Home Depot. Operating section includes the revenue from the sales. One expense is the cost of goods sold, and the other is SG&A expense, depreciation, and amortizations. You also see two intermediate components, the gross profit, operating income. So we have these two margins, and we can calculate the profit margin for these two items. We can calculate the gross margin using the gross profit scaled by revenue. For operating margin, we can use operating income scaled by the top line net sales to evaluate the company's financial performance. Following operating section, these are non-operating section. You can see interest income, investment income, interest expense. So these are all related to the investing and the financing activities. There are different formats of income statements. For investors who just need the bottom line, this version, the single-step income statement, is more appropriate for them because basically they just compare the difference between the inflows and outflows of assets. Inflows represents all the revenues and gains, and outflows represent the sum of expenses and losses. Finally, they get the difference. If the investors want more detailed information, multiple step income statement is more appropriate, which is commonly used. If you check the income statement of all the public companies, they report multiple step income statements because it provides several intermediate components for the investors to evaluate the company's performance. Gross profits, operating income, income before income tax, or net income. The single step, you just have one, the bottom line. Different intermediate components, we can construct different financial ratios, represents the different aspects of its financial performance. Here is an multiple choice questions. For the single step income statement, the total revenue and gains.